Chapter 4. And you can see them right here. We'll talk about the flow of accounting information. We'll talk about preparing financial statements, closing entries. We'll talk about the accounting cycle, and then talk about what a fiscal year means, and then also use a few ratios about working capital and the current ratio. So I kind of like Chapter 4 in that it shows us the entire accounting cycle. You kind of get to feel for what accounting really is. You get to begin to feel like this is why we do it. This is the end result of financial statements, and how do we get there. So if you can recall, some things we've done previously, we have done transactions, journal entries, adjusting entries, trial balances, things like that. And in Chapter 3, you spent quite a bit of time doing adjusting entries and computing what they call the adjusted trial balance. And so what you can see here is kind of a slice of a spreadsheet from our sample company Net Solutions. And you can see that we have the unadjusted trial balance, our adjusting entries, and then the adjusted trial balance, which then of course is used to create the financial statements. So whenever you have the adjusted trial balance columns, and notice that everything is in balance, every set of columns, debits and credits equal, you can see that going from left to right. And you get to the adjusted columns here, and that results in financial statements. So we've got our income statement here, Net Solutions income statement for 2 months ended December 31. Remember, this company just started in November. And we have our revenues, which are fees earned and some rent revenue, and a whole bunch of expenses, wages expense down through miscellaneous expense. And you can see that revenues less all of my expenses equals net income, which is $7,105. It's kind of small, but it's $7,105. And then you can see the balance sheet also comes from that, and I know that's really small, and you can just pull out the actual PowerPoint from the handout section if you want to get a little bit better look at that. But the data really comes across as small here as I give this presentation. But you can see that basically anything that's in yellow, which is your assets, your liabilities, and your equity accounts, and so cash all the way down to capital stock, all of those belong on the balance sheet. Okay, so assets is $29,495, and liabilities plus equity is the same number, $29,495. And then the green number goes to the statement of retained earnings, or statement of equity, sometimes it's called also. And so remember that this is a brand new business that just started on November 1st. They started out with 0 retained earnings, and then as they had net income, and remember that $7,105 of net income comes up and is on the retained earnings statement, minus dividends, the $4,000 right here, gives us then ending retained earnings of $3,105, and that number then goes to the balance sheet. And so these three financial statements are connected. You do the income statement first because you need to put the $7,105 of net income on the retained earnings statement. You compute your ending retained earnings, then that number is transcribed and goes to the statement of equity. Okay. And so it says the flow of accounting information. We have an end of period worksheet, and that's really kind of what we just got done looking at, is what they call an accounting worksheet, or the end of period worksheet, or just the worksheet. I've seen it called many different things. And it says the account balances are listed first under unadjusted trial balance, right? Basically kind of how we got to in Chapter 2 by doing journal entries, and then we could create a trial balance. And then in Chapter 3 we learned about doing the adjusting entries, right? And there's some examples of deferrals and accruals were the two broad categories of adjusting entries. And then you can see next is the final column, the adjusted trial balance. It says adjustments are combined with the unadjusted trial balance amounts to provide balances for the adjusted trial balance columns. Okay, and so you combine the first two to get to the third column. So you add your numbers from unadjusted, you combine those with the adjustments to get to the final adjusted trial balance amounts. And then once you do that, you add 2 more columns to the worksheet, one for your income statement accounts and then one for your balance sheet accounts. You simply extend the amounts from the adjusted trial balance into either income statement or balance sheet, depending on where that particular account fits into the financial statements. Okay, so that's the next step, is we'll take the adjusted trial balance and turn it into financial statements. So it says the income statement for Net Solutions is prepared directly from the income statement or adjusted trial balance columns from the worksheet, and it says beginning with fees earned of $16,840. Okay. And so those are the same numbers we looked at previously just a few screens ago, and this is just a little bit better look of the income statement, a little bit bigger size so we can view it better. And you can see it's just fees earned, revenues earned, total revenues minus all of my expenses to get down to net income of $7,105. And so the retained earnings statement, it says the first item normally presented on the retained earnings statement is the balance of retained earnings account at the beginning of the period. Right? We start out with a beginning number. For our sample company, it's 0 because it was a brand new business. Okay, and so the income statement gives us my net income number, and the balance sheet gives me, or the number from the worksheet I should say, gives me my dividend number. The balance sheet is prepared directly from the balance sheet adjusted trial balance column, beginning with cash of $2,065. Okay, so there's my cash right here. And so notice I start out with my current assets, assets that have a duration of 1 year or less, cash, receivables, supplies, prepaids, I subtotal that. Then I have my long-term assets, assets that I expect to be able to use for more than a year. And you can see I've got land, equipment, accumulated depreciation to get down to a total property, plant, and equipment. And then I have my liabilities and my equity, and of course I balance $29,495 on both sides, and that retained earnings number comes from my statement of retained earnings. And so we classify our balance sheet, and we do that by separating it out into different categories. We classify assets and liabilities based on their duration, basically 1 year or less or more than a year. So anything that's 1 year or less is a current asset or a current liability. Anything that's more than a year is long-term, either asset or liability. There's lots of examples of current assets. There's just a few right here. And you can see that we've got cash, receivables, note receivables, and supplies are some common ones. A note receivable is typically an amount borrowed from a bank. Sometimes you can have a note receivable from a supplier that you're buying on account from. Sometimes if you want to negotiate a longer deal to pay them back, they might be okay with that and issue a note receivable in exchange. So basically just a written promise between two people to pay a sum of money plus interest at some certain date in the future. So if that note receivable has a duration of 12 months or less, it would be considered a current asset. Fixed assets are typically property, plant, and equipment, items that we can look at, see, and touch. They will last a long time, and so we classify them as fixed or long-term. Machinery, equipment, buildings, land are all examples. It says that we depreciate these assets over their useful life, with the exception being land. Land is the one asset that we do not depreciate. Current liabilities, simply abilities that will be due within a shorter period of time, typically 1 year or less. And so think of some of those accrued entries that we did. If we had wages payable, interest payable, or unearned fees, accounts payable, just simply liabilities that arise from the normal course of business that have a duration of 12 months or less. And long-term liabilities, they're not due in the short term, they're due more than a year out. And you can see typically they involve debt. Long-term notes payable, a mortgage payable, or bonds payable typically are due past 1 year, over 1 year from now. And finally, we have stockholders' equity, which is basically the owner's equity in the business, which for most corporations is made up between capital stock and retained earnings. Okay, so Some newer information for us for this particular chapter is the process of closing entries. And we get to the end of an accounting period and we do the closing process. And we do that so we can update our accounts and get them ready for the next accounting period. So we can start out, we're doing stuff here as of December 31st. So we close our books for 1 year and we prepare them to be ready for the next year, which would be January 1st. And so we categorize our accounts into two broad categories, and that's permanent or real, or temporary and nominal. So permanent and real mean the same thing. I've seen different books use different terms, and same thing with temporary and nominal. I'm more used to permanent and temporary is what I use the most, so that's probably what you'll hear me say as I record these, but you may also have heard of a real account or a nominal account. So accounts that are relatively permanent from year to year are permanent accounts. We carry their balances forward from 1 year to the next. And in some accounts we only record their balances for one accounting period and then we close them. Okay, so we get to the end of the period, a temporary account, we find out what their ending balance is, and then we close the account to get it ready for the next accounting period. And so to do that updating and do the closing process, it says reports. To report amounts for only one period, temporary accounts should have a zero balance when we begin the next period. And so to achieve this, all revenue and expense accounts are transferred to an account called income summary. Okay, so all of your revenue and expense accounts are temporary accounts, and so is income summary. But income summary is just a special temporary account that we use as a part of the closing process. And so what we do is we transfer the balances of all revenues and expenses to income summary, and then we come up with a net number in income summary, which would represent either our net income or our net loss, revenues less expenses. We then take that number and we transfer it to retained earnings. And then finally we also close the dividend account. Okay, and we transfer the balance of that dividend account also to retained earnings. Okay, and so the entries that transfer these balances are simply called our closing entries. And so this is just a good kind of a one-stop shop to see all four of the closing entries. Now these are not the actual debits and credits, but at least the four concepts of the closing entries are all right here. So number one, we close revenues. And so remember that revenues have a normal credit balance. So therefore we would debit revenues and we would credit income summary. Then number two is we close expenses. Expenses have a normal debit balance, and then we would credit expenses to close them and debit income summary. And then net income or net loss would be the resulting balance. So income summary is going to have one number in it that will either be net income or net loss, and is transferred to retained earnings. And then retained earnings and also we close dividends to retained earnings finally. Okay, so there's the four things we do are all on this one screen. So income summary then is a temporary account that's only used during the closing process. At the end of the closing process, we close it, and it will end up with a zero balance. Okay, and closing entries are always done at the very end, one of the last things that we do, and we give them the date of the last accounting period. So December 31st, for example. Okay, so here is an example then of journalizing and posting our closing entries. And so you can see here that the number one, it says debit each revenue account for its balance and credit income summary for the total revenue. Okay, so entry one, close revenue accounts. Revenue accounts have a normal credit balance. We give them debits and we credit income summary to transfer the balance over. Entry two is to close expenses. So in the blue accounts here, all the expense accounts that I have, they have a normal debit balance, and so I give them a credit, and then I do a net debit to income summary to close it out. Third, I transfer those balances to income summary, and so I debit income summary and I credit the retained earnings account for that amount. Now, What you should understand then is that that number is, remember, that was my net income number, okay? Because I've got my revenues here in income summary, I've got my expenses, so it's revenues less expenses equals net income. That 7,105 is also my net income number that we showed previously. Then finally we close the dividend account. It has a normal debit balance. I give it a credit. I debit retained earnings, and now I've closed that out and I'm ready. So my retained earnings now includes a credit for net income, which makes it go up, that's what I want, and it includes a debit for dividends, which reduces retained earnings, which is what I want. And so of course we have to actually put those closing entries into a journal, post them to our ledger. That's the posting references to show that yes, they were posted to our ledger. And you can see what the 4 entries are right here, steps 1, 2, 3, and 4. So after the closing entries are journalized and posted, all temporary accounts, which are your revenues, your expenses, and the dividend account, should all have a zero balance. Okay, and so here is my ledger, and only permanent accounts should have a balance. So your permanent accounts are your assets, your liabilities, and your equity accounts. So you can see here I've got assets that all have a balance. I have some more assets here. I also have some liabilities and some capital accounts, all with balances. And you can see my income summary account has a zero balance, dividends has a zero balance, and then my expense accounts have zero balances. And then also my revenues and expenses have zero balances. So therefore, a post-closing trial balance is prepared after closing entries have been posted. The purpose of the post-closing is to verify that the ledger is in balance and ready for the next accounting period. So the last thing we do is put together a post-closing trial balance, and to verify that we've done everything correctly, there should be no temporary accounts here. So I don't want revenues, I don't want expenses, I don't want dividends. If they show up here, that means they have a balance. And if they have a balance, that means my closing process wasn't quite right. Okay, so I only want permanent accounts to show up here. I want it to balance, and that just shows now I'm ready to begin the next accounting period, which is start January 1st. Okay, so next let's talk about the accounting cycle. And basically just the process that begins with having journal entries. We analyze them, we look at source documents, we journalize them, put them together, and then get ready for accounting entries. It says there's 10 steps to the accounting cycle. Okay, and you can see what the 10 steps are right here. We analyze and record transactions in the journal. We post from the journal to the ledger is number 2. Number 3, we put together the unadjusted trial balance. Number 4, we do adjusting entries, what we learned back in Chapter 3. Step 5, we put together the end of period spreadsheet where we have the unadjusted trial balance, the adjustments, the adjusted trial balance, and then columns for income statement and balance sheet. We then, of course, had to journalize our adjusting entries and post them to the ledger so that we can do an adjusted trial balance. With our adjusted trial balance, can put together financial statements. Once our financial statements are done and they all balance to each other, then we can do the closing entries, journalize and post those, put together a post-closing trial balance, and now we have closed out the accounting period that has also completed financial statements. There's a lot going on there that has to happen, right? This just kind of gives you a visual for the steps in the accounting cycle. So you can see we start out with number 1, journalizing transactions. Number 2, posting to the various accounts. Number 3, preparing the unadjusted trial balance. Number 4, assemble adjustment data, right? Make sure that we are recording all revenues earned in the accounting period. We match those against all expenses incurred in the accounting period. So make those entries. That was step 4. I don't see step 5. I don't see it on there. Step 6, at least let's go to that one. Journal, there, step 5. It says 6 here, but it should be 5. Journalize adjusting entries. Then we post the adjusting entries. And then we prepare the adjusted trial balance, making sure that our adjusted entries plus our unadjusted trial balance combine into a completed adjusted trial balance. And the adjusted trial balance is the source for me to prepare financial statements. Okay, and so let's see, there's also two number 9s, journalize closing entries, post-closing entries, and prepare the post-closing trial balance. So a couple numbers were quite a little bit wrong there, but that should give you a feel for how that all works together. Okay. So here then it says optional, step 5, prepare the adjusted spreadsheet to put together your, you don't have to do that. I'd recommend doing it. I always think it kind of gives you that visual that you can see how the numbers flow through better, and then also preparing the financial statements. So let's go ahead and just take our sample company, or a new sample company I should say. This is for Kelly Consulting for the month of April, and you can see we've got several journal entries to reflect transactions that have happened for the month of April. You can see the posting references completed, which means they've all been posted to our ledger. So just a series of journal entries in our journal, chronologically ordered, first of the month all the way down. Then we get to the second page of the journal here with some more entries. And we get to page 2, you can see a few more entries there. And so that gives me then, I can put together my unadjusted trial balance. Just assume that we had posted all these journal entries to our ledger, and then we could summarize our ledger accounts and transfer their balances to the unadjusted trial balance. You can see that that balance is $56,750 for both sides. I can then drop that into an unadjusted trial balance, and you can see that it's the same $56,750. And then of course we do our adjusting entries, what we learned back in Chapter 3. You can see we can use this spreadsheet to identify where we might need to include them. Depreciation, for example, making sure we're matching up revenues to expenses earned in the month of April. That's what all these are about. Recording expenses that we need to accrue, revenues we need to accrue, things like that. And so the combination of the unadjusted trial balance plus the adjustments gives me the adjusted trial balance over here. And then of course I have to actually journalize and post all of the various adjusting entries, so that's what this is doing for us. Okay. And then once I do that, I can prepare the adjusted trial balance. It balances $57,200 for both sides of the debit and credit down here. And then once I have the adjusted trial balance, that is the source for me to put together my financial statements. So if I go back to the adjusted trial balance and I go down to the revenue section, so it says fees earned, that's my revenue, $23,450, and then I have a whole bunch of expense accounts down here. You can see what they all are. So revenues less all of my expenses. Here's my revenues, here's all of my expenses. There's my net income, $18,300. Okay. So remember that $18,300 for this business. It's brand new. Its first month of activity was the month of April, and so we had 0 retained earnings beginning. We add net income, and then we take out dividends. Okay, $6,000 worth of dividends. If I go back to the adjusted trial balance, I can see dividends right here with the debit balance. Okay, that's where that came from. So that leads me down to $12,300 for retained earnings. And I go to my balance sheet, and it's a matter of just taking the adjusted trial balance and dropping in the dollar amounts here. Okay. So you can see I've got cash, receivable, supplies, prepaid rent, prepaid insurance. You can see those numbers there. We can go back to here and see them here. Cash, receivable, supplies, prepaid rent, prepaid insurance, office equipment. And then on the right hand side, notice that you have accumulated depreciation of $330. Okay. Now remember, that's a contra asset account. And so it's an asset account that has a credit balance. And so a mistake I see people make is they see that over there on the credit side and think it must be a liability, but it's not a liability. So let's go back to the balance sheet. And we'll see that under property, plant, and equipment, we list the office equipment, the 14,500. So let's go back to the balance sheet and I'll show you where that came from. There's my 14,500. But I have to subtract from that the accumulated depreciation of 330. So let's go back down there. 14,500 minus 330. I get down to the book value of my property, plant, and equipment, cost minus depreciation taken, to get down to 14,170. Add those two together, I get 45,720. Okay, so a mistake I see people make is instead of subtracting that from the asset, that accumulated depreciation of 330, I see them included as an increase to liabilities. And the funny thing is your balance sheet would still balance if you did that. Okay, so you don't necessarily notice that's the mistake that you made until you go and submit it for correction or to get the grade. So just don't make that mistake if you can avoid it. That's what I'm asking you to do. And just know that when you see accumulated depreciation, it's a subtraction from the fixed asset. Okay, and then the rest of the accounts came from the adjusted trial balance, except for retained earnings at 12.3, which came from my ending number of my retained earnings statement right here, the 12.3. And so once you're done with that, you can then do your closing entries, right? So it's a matter of closing out your temporary accounts in the 4 steps. Step 1 is to close your revenue account, which is fees earned. Step 2 is to close your expenses. Step 3, close the actual income summary account. And step 4, close a dividend account. And the reason how you know you got this right is going back to the income statement. Our net income was 18.3. Okay, so if I go back to the closing entries, my debit to income summary for step 3 was 18.3. That was my net income number. So it's kind of that little self-check you can do when you do these, is to say, okay, my entry number 3 for my closing process needs to be the same dollar amount as my net income that I had in my income statement. And with the same number, which means we're doing this correct. Then I run my post-closing trial balance, right? And remember that this should only be permanent accounts, your asset, your liability, and your capital accounts. Everything else should be zero balance and you don't include it. So your revenues, expense, and the dividend accounts all have a zero balance, so we don't include them here. And we look at our ledger just to see that everything was posted. And so all those journal entries that we had for the month of April have been posted here. Our adjusting entries have been posted here. And our closing entries have been posted here. Notice that on the screen you just have assets and liabilities. So there's no adjusting entries here. And then here you have some other assets and you have capital, stock, and retained earnings. And then here you have your temporary accounts. You've got dividends, income summary, and expenses. And then you also have your temporary accounts, your revenues, and some more expenses. And you can see that they include both the adjusting and the closing entries posted, and all temporary accounts have a zero balance. Okay, let's talk next then about an accounting period or a fiscal year or a natural business year. An accounting period is just simply an amount of time. The annual accounting period by a business is its fiscal year. A lot of for-profit businesses will typically go with January 1 to December 31st. Every for-profit business I ever worked for did it that way. But now USF is a nonprofit, so their fiscal year is just 12 consecutive months, which actually starts July 1st to January 30th, which is pretty common for a lot of nonprofits. So your fiscal year can be a calendar year or just simply 12 consecutive months. So here's some examples of companies and their fiscal years. So you can see there's a big range here of different fiscal years for different companies. It's really up to them how they want to do it. Okay, it's just my experience. Every company I worked for that was for profit actually went with the calendar year. Okay, also just know that it says financial history of a business, and that includes, of course, all previous financial statements. Okay, so you can see here my income statement for December 31st covers, it says for the year ended. It's basically what was our total revenue, and our total expense for the entire year. And the balance sheet is for a point in time, typically the last day of the fiscal year. So an income statement covers the whole year. The balance sheet's a snapshot of how we did at the end of a year. And you can see that's kind of what they're showing us here for 3 years. And also, just so you know, publicly traded companies are required to issue 3 years worth of data at any given moment in time. So they always issue the current year and then 2 prior years. Let's talk a little bit about working capital for a business. Working capital and the current ratio. So working capital is your assets. And so it says the ability to convert assets into cash is called liquidity. The ability of a business to pay its debts is called solvency. So you want to make sure how liquid and how solvent a company is. And working capital is a way to measure that. And working capital is just simply current asset minus current liabilities. So you hear the term working capital, just think current asset, current liabilities. So current asset minus current liability. And so in the company we've been looking at throughout the book so far, Net Solutions, we've looked at their data pretty much every chapter now. It says that Net Solutions working capital at the end of the year was $6,355, which is simply looking at its balance sheet, looking at the current asset number, subtracting the current liability number, and there it is, $6,355. Okay, so that looks like a good number, but a better way to measure that is actually to turn it into a ratio. And so when I turn that into a ratio, I'm expressing 2 numbers into one number. Okay, so it's a very easy ratio to compute. Simply current asset divided by current liability, and I get the number here, 5.6, which is really high. I've seen other accounting books that say, ballpark for a good number is 1.5, and this one's really high. One way to think about that 5.6 is for every dollar of current liability, we've got $5.60 of current asset. Okay, so in other words, this company has a lot of current assets compared to current liabilities and can easily pay off its current bills with current assets without having to worry about liquidity issues or anything like that. Also keep in mind that ratios are best when they're compared to something. And so quite often businesses will compare several years worth of their own data into ratios. It'd be interesting to see what our current ratio is for, let's say, 3 years. Net Solutions is a brand new company, so we can't do that. Let's just project that out a couple more years. The company should look at what its current ratio has been over the years, and there's other ratios we can compare to. And also you want to compare yourself to your key competitors and to industry averages. So those are just all good things to compare a ratio to. And just some supplemental data that's towards the end of the chapter, and this just kind of walks you through a little bit more detail about the worksheet process. Remember, we started out with a trial balance. We adjusted the accounts that need adjustment, and we begin to plug in all of the adjusting entries, which all came from Chapter 3. So I'm kind of going through this fast just because I feel like we've already done this, but I just wanted you to be aware that it's here. Okay, and so we're just dropping those adjusting entries in. And then the key thing, though, is when you go from left to right to compute the adjusted trial balance, you do have to be very mindful of the rules of debit and credit. Okay, and that's really what I wanted to show you with this. So, for example, account receivable, you get a debit at $2,220, another debit 500, so you get down to $2,720. For supplies, you get a debit at $2,000, a credit of $1,240, so you get down to a debit of $760. For prepaid insurance, $2,400 debit, $200 credit. There's my debit at $2,200. So you have to be very mindful of the rules of debit and credit going from left to right. And the check, of course, is that everything totals, that you want to make sure that all 3 columns, that the sum of debits and credits equal. That's kind of your check that you did it right. Okay, and so of course preparing the work as a spreadsheet allows the computer to assist you in doing the math. So of course you can build Excel formulas that will do all that math for you, which makes it a little bit more accurate than doing it by hand or using a 10-key calculator or something like that. And so once we have a good adjusted trial balance, What we do then is combine that into either the income statement columns or the balance sheet columns. Let me just make sure you can see all the headings here. There we go. And so you can see here, I went too small. Let me get that list a little bit bigger. Okay, it's hard to find the happy medium, but just know we've got the income statement columns and the balance sheet columns are both there. Okay, and so that's all that means is we just summarize these. And once we do that, you can see that they don't initially balance, that revenues less expenses we know as net income. And what we'll discover here is that the income statement columns and the balance sheet columns don't total, they don't balance initially until we compute net income and we add the net income number. So the difference between each one should be net income, revenues less expenses, and that's what the income statement column shows. My revenue is $16,960, expenses are $98.55, the difference is $7,105, and I should need that number as a debit on one side and a credit on the other, assuming we have net income. If I had net loss, it'd be a credit on the income statement and a debit on the balance sheet would make a balance. Okay, so I plug that in, and now I balance. Okay, so I have to plug in the net income number, and now all of my columns balance. Okay, so that was Chapter 4. As usual, when you study, reading your chapter is really critical. Asking me questions if you're not quite sure how things work is also helpful. And of course, just doing some of those practice study plans in Cengage Now you'll find to be very useful also. Thanks.